already covered a lot in this module. In this final lesson, I'm going to introduce a fundamental concept: support and resistance.
I've honestly never heard of support and resistance before. Does it have anything to do with charts and candlestick patterns?
Kind of. We will definitely need a chart, but it doesn't have to be a candlestick one. You can actually identify support and resistance on most chart types.
But why do I need to know about support and resistance?
Well, understanding the concept of support and resistance is a foundation of technical analysis. Also, knowing the reasons why support and resistance forms is essential if you are contemplating becoming a good technical trader. Remember, earlier in this module, when we were introducing technical analysis, we discussed the idea that if loads of traders are looking at the same patterns, they become self-fulfilling.
Sure, yes. It was a bit difficult to get my head around, but I understand it now.
Well, support and resistance is exactly that in practice. The concept is used by traders to identify price levels that could potentially act as an obstacle and prevent the price from getting pushed in a certain direction. These are psychological levels in the market because lots of other market participants have identified it as a level. It becomes one and gains more strength over time. We are trying to work out where we think these levels might be and therefore what might happen in the future should the price get to these levels again.
Well, that sounds good to me. Let's get started with the basics.
Yep, I'm looking forward to getting stuck into this one.
The essential concept of support and resistance is actually very simple. We are talking about the levels in the market that are preventing the price from moving higher. That's resistance. And the levels that keep the price from going lower, that's support.
Can you show me the concept at work in a real market, please? I think that might help.
Sure. Okay. So, in this example, we are looking at the price of gold. Let's look at a simple resistance level. So, here the price has risen. We touched on what happens in bullish trends earlier in the module. Buyers are happy paying a higher price for the security, and sellers are asking for an ever-increasing price until it hits resistance zone here. At this point, just below 1,300, buyers aren't happy paying anymore, and the sellers have eased off asking for a higher price. As the chart develops, you can see that this level was challenged again and again. Buyers are refusing to pay anymore.
Right, I see what you mean. So if the price returns to that point again at some point in the future, because we've identified it as being a resistant level, we can expect some pushback from buyers being asked to pay more.
Yes, in a nutshell, this is what resistance looks like.
Why are they refusing to pay more?
Well, from a technical trader's point of view, and this is a fundamental aspect of technical analysis, we don't know why. We just know that there is resistance to paying more. To answer the why question, we would need to go beyond technical analysis and use fundamental analysis.
And what about support? Is this when the price is falling?
Support is the opposite of resistance. It's when there is a psychological level that prevents the price from falling further. When a price is falling, bulls are on the back foot, and the bears are pushing them to accept a lower price. There comes a level at which this imbalance stops, and the price stops falling. This is support.
Good. This is all making sense.
Wait a minute. Does that mean that the price can't go any lower when it hits support? Or any higher when it hits resistance? That doesn't make sense.
We are not saying that. It can certainly move higher and break through resistance or fall through support. In this type of analysis, it's not black and white. Support and resistance is subjective. And all we are trying to do is identify areas where the probabilities are in our favor.
So is it possible that one trader might see things differently to another?
Absolutely, that's entirely possible. You might have traders looking at it in different chart types, different time frames, or you might even have traders who aren't looking at it at all.
In the last example, I noticed that you called the resistance level a zone. Is that because it's subjective?
Yeah, that's exactly why. We might talk about a resistance zone or a range instead of a precise price.
So, we shouldn't be too concerned if it goes slightly over?
No, it's testing resistance. Try to see the bigger picture. The price is testing this area.
I like it when things are certain, but accept that there's subjectivity in this type of analysis. Is there anything we can do to at least help us get more certainty?
Yes, there is actually. When we identify these levels, we do so with a varying degrees of confidence.
Great, how can I do this?
The more a support or resistance area is tested by the market and holds, the stronger it becomes. Going back to our resistance example, think about what's happening here. Collectively, the buyers are refusing to pay a higher price. Each time they refuse, our conviction that this is an important level increases. It's natural human behavior. Strong areas are referred to as being confirmed, and we give them more weight in our analysis.
Okay, I get it. And because other traders are looking at it, it becomes more of a significant level.
Yeah, you've got it. And it becomes self-fulfilling. More and more traders now see this level that's difficult to pass, therefore making it harder to break through.
But what happens if the price goes above the resistance level? Does it become irrelevant?
No. If the price moves above a resistance level, that level becomes a potential support level, albeit a weak one until it gets tested. Think of it in this way. Imagine support levels as a floor and resistance as a ceiling. If the price goes through the ceiling, it becomes the new floor beneath you.
Okay, I see. So that means if you break through a resistance level, it becomes a support.
Okay, but what if you fall through the floor?
Well, if the price loses support and sends you crushing through the floor and you land in the basement, the old floor becomes your new ceiling.
Right, so it's a new resistance.
That's the basic idea, yes.
Okay, good. I think I understand the basics of support and resistance now.
Welcome back. In the last video, we covered how resistance lines are often explained as a ceiling and how support levels can act as a floor.
Yes, you explained that well. It began to click when you described the tussle between buyers and sellers, which reflects in the price.
The chart that we looked at to demonstrate resistance was obviously pre-selected to prove a point. In this video, however, we are going to look at a practical way of identifying potential support and resistance areas before they get confirmed by multiple touches.
Sounds good.
The first place to start is to understand the significant levels tend to form at previous highs or lows in the price. Whether it's support or resistance depends on where the current price is. Let's show this on a chart for the UK 100 and see if we can identify some potential support and resistance levels. Can you tell me where you think the significant lows and highs are? Remember, a low is a turning point when a downward trend reverses and heads up. A high is the opposite.
So do you mean here, here and here?
Yes, that's right. At these significant lows and highs, we place horizontal lines or zones on the chart and extend that point to the present day and into the future.
Can it be any high or low?
Pretty much. to start your analysis, yes.
What do you mean when you say to the present day and into the future?
Well, remember that this here is the current price, and down at the bottom axis is the time. So this bit here is the future. When I draw my line or a zone, I make sure that it extends over to the right, so it's useful for us right now.
Right, I see.
Now, we got some potential levels of interest, because the current price is here. The level above it is potential resistance, and the two below are potential support levels.
Are any of these levels stronger than the others?
Well, because this one has been tested twice and not held, I would say it looks to be fairly weak. If we let the chart run forward, the first potential support level gets tested and fails again. So we can probably discount that one as being psychologically important. But the lower support level gets tested a few times here and holds. So I'd immediately give that level more weight in any analysis. It is a confirmed support level.
And what happens with resistance? Is it just the same process, but with the price testing it from below?
Exactly. If the price starts rising and gets near this potential resistance level, I would be looking to see if it gets confirmed.
Fantastic. I understand it.
A final point on confirming horizontals. Make sure to check across multiple time frames for additional confirmations. Our chart here is a 4-hourly time frame. If I can quickly show you a daily chart, you can see the support level at around 7,300 has actually been tested multiple times in the last couple of months. This chart package lets you carry through any analysis to different time frames.
Oh yes, I see. So that makes it a significant level. Are horizontals the only areas where we might identify support and resistance?
No, there are loads. Let's touch on some of the other basic methods. Another common strategy for identifying potential support and resistance levels is to simply use round numbers. In our UK 100 example, the support line of interest was developing at 7,300. And in our gold example, the resistance was around 1,300. Round numbers are good places for support and resistance to develop.
Really? Why is that?
Well, some traders tend to place their stop or limit orders at round numbers. So when these get triggered, it might be enough to get the change of equilibrium between the buyers and sellers, between bulls and bears.
So, because people like round numbers, like 7,300, they become areas we should be interested in. That's pretty useful. So, now that we're able to identify these levels, can we use them to place trades?
Well, some traders do. It's called range trading. They find ranges of support and resistance, and their strategy is simply to buy when the price hits support and sell when it hits resistance. You can have a go finding these ranges on your broker's practice account, but I'd reiterate that the trading techniques and strategies we are building towards involves support and resistance, but only as a one layer of evidence.
Okay, I'd like to learn a bit more before I start trading.
I think that's a wise choice.
Is there anything else we need to know about support and resistance?
Yes, loads. I'm only going to list them here, but there are other ways to identify support and resistance. We can identify them by using trend lines, moving averages, Fibonacci retracements, and daily pivots.
I think I might know what a trend line is, but I'm blank on the other three.
Well, don't worry, we will cover all of these in our advanced courses. This lesson is about the basics. So for now, let's move on to the summary. Welcome back, everyone. In this lesson, we are looking at the concepts of support and resistance. We actually introduced this topic as a key concept at the end of our Beginning to Trade course. Understanding support and resistance and what causes it is at the heart of every good technical trader skill set and key to determining the trend. In this module, we are going to refresh what we learned there and take it further. We are going to examine what support and resistance is and why it forms. We'll then look at some additional ways to anticipate it.
I hate to admit it, but my memory is a bit hazy on this topic. I think I'll need a refresher to familiarise myself with it again.
Don't worry if you are a bit rusty on this. We assume that you are familiar with the basics, but for the benefit of those that are joining us for the first time, we are going to refresh horizontals and round numbers.
Okay, so where do we begin?
Well, from what I remember, the concept of resistance is concerned with psychological price levels in a market that are preventing the price from moving higher. Is that right?
Well remembered, that's right. Resistance levels are commonly regarded as a ceiling because the psychological levels prevent the market price from moving higher. This is where the power of the bulls shift to the bears. Remember, as technical traders, we aren't concerned with the why, we just know there was a level in the past where there was a change of power from bulls to bears or vice versa. Market participants won't forget this point, and the reasons they had for changing their opinion may still hold, so we as technical traders should factor this into our analysis.
This makes sense. So resistance is about the ceilings that are placed on the market, and what about support?
Support refers to levels acting as a floor by preventing the price from being pushed lower.
So this is where the power is shifted between bulls and bears previously below the current price.
Yes, essentially, support is the opposite of resistance. It's when there is a psychological level that prevents the price falling further.
Got it.
When a price is falling, the bulls are on the back foot and the bears are pushing them to accept a lower price. There comes a level at which this imbalance stops and the price stops falling, which is support. When we analyze support and resistance, we use a number of methods to try to work out where these levels might develop in the future, and therefore act as a layer of evidence towards placing a trade.
And what are these methods?
Well, let's look at the most common ones in the next video. So, we've introduced horizontals. John, what do you remember about them?
When identifying horizontals on a chart, the first place to start is to understand that significant levels tend to form at previous highs or lows in the price. This is, by definition, where the market has experienced support or resistance previously.
And how do we know if it's support or resistance?
This depends on where the current price is. If the current price is below where the previous high or low is, it's potential resistance. If it's above, it's possibly support.
That's right. In terms of drawing horizontal lines on a chart, they are most relevant if they're created at significant highs or lows.
And once we've identified the highs and lows, we place horizontal lines or zones on the chart. Yes, it's all coming back to me now.
Okay, have a go at drawing in the support and resistance areas.
So, a potential support line is drawn from the previous swing high or low above the current price and is...
So, we know from the previous lesson, identifying a trend is the objective of technical analysis. One of the methods that traders use to identify trends is to connect areas of horizontal support or resistance. Knowing the direction of the prevailing trend should feed into a trading strategy. Second, trend lines act like dynamic support and resistance. We project them into the future to identify potential areas where the price might reverse and change direction.
So what exactly is a trend line?
A trend line is a straight line that connects significant highs or significant lows. Look, if we connect the higher lows with a straight line, it becomes a bullish trend line. With these higher highs, we do the same.
Right. So can we draw trend lines to basically help us identify the direction of the trend? Would we say this example is of an bullish trend?
Yes, do you recall we said the most recent price action was the more important?
Yes.
Well, by connecting these lows and highs, our analysis is telling us that the most recent and more significant support or resistance levels are being found at subsequently higher prices. That is a pretty good indication that the market is trending up.
And how do they help us identify potential support and resistance levels?
Well, if you project the trend lines forward, what you now have are potential areas in the future where support and resistance might form. The next time our price approaches either line, we would consider it possible support or resistance.
Okay, I see. Is it the same for a downtrend?
Yes, but you're connecting lower lows and lower highs. Look, we connected lower lows to project potential support. We connect lower highs to get our potential resistance. I need 3 touches before I can call it a confirmed trend line. Then the more touches where the trend line is tested, the stronger it is. As it develops, the more technical traders in the market will be noticing and trading it. Therefore, the more significant it gets. As before, if there is more volume traded at these points, then that's also adding to its significance.
This makes sense. It's all good in theory, but can you show us one in a real market?
Yes, let's do that now. Let's pull up a chart of the S&P 500. That's the index of the largest 500 companies in the US. So, this is a support trend line developing. We've drawn the line from the closing prices. I can see it being tested at least 6 times and confirmed. It hasn't been broken, so traders would attach quite a bit of significance to it should the price return to it.
That seems pretty straightforward. I notice you only drew in the support line. Do you need to have a resistance line connecting high highs as well?
No, not necessarily. Sometimes you get a clear set of support and resistance lines developing and you can draw in a channel. In fact, there might be one here. This is a weaker resistance trend line. It's only been challenged 3, maybe 4 times, and the price has just broken through it. In an uptrend, the important line in our analysis is the support line. This is because the bulls who are driving the trend are being really tested. They are withstanding the pressure and the trend is continuing. In a downtrend, the important line is the resistance.
Okay, what about the angle of the lines? If the trend line is steep or shallow, does that mean anything?
You are on fire today. You've actually picked up on something really important. A steep trend line suggests one party, the bulls or the bears, are in complete control. This exuberance typically doesn't last long. As traders, when we see a really steep trend, we are looking for signals that it's running out of steam. Also, too shallow and the trend might be too weak to trade. I mentioned before, and it's worth noting again, that support and resistance is self-fulfilling. We know horizontals from previous highs, lows, and round numbers can be potential areas for future support and resistance, as well as trend lines connecting these areas. If we logically roll this forward, it means anything popular that market participants use to form opinions on price can also be used by technical traders to better understand potential support and resistance. Basically, if lots of other participants are looking at something, then that is worth us analysing it.
Yes, it's all about what market participants expect the market to do. When there's a lot of indications that the market might move in a certain direction, and if everyone is looking for it using the same techniques and tools, then it can become self-fulfilling. Participants start trading, buying, selling and setting orders based on these indicators.
Good explanation.
Okay, so what indicators help us find support and resistance?
Well, it can be any popular indicator or technique. You probably won't know what they are yet, but moving averages, Fibonacci retracements, pivot points are three technical analysis tools that are widely considered useful for helping spot support and resistance.
I can take an educated guess of what a moving average is, but the other two I really don't have a clue about.
Well, that's fair enough. I will explain each one in detail a bit later in the course, and I will be sure to go through support and resistance examples then. All you need to know at this stage is support and resistance develops at levels of psychological importance. What constitutes psychological importance can be as simple as a round number, a previous turning point, a trend line, as well as any popular tool or technique that gets the market participants trading in a collective group. As analysts, we should be looking at the popular techniques if we are to develop our edge.
In trading, resistance is concerned with psychological levels in the market that are preventing the price from moving higher. Support is concerned with the levels that keep the price from going lower. Essentially, support is the floor and resistance the ceiling.
Horizontals are a practical way of identifying potential support and resistance areas before they get confirmed. They tend to form at previous highs or lows. When charting horizontals, a line is drawn from a previous swing high or low above the current price and projected into the future. This represents a potential resistance level. A horizontal line from a previous swing high or low below the current price is projected into the future to represent a potential support level.
Round numbers are also a common way of identifying support or resistant levels because some traders like to place their stop or limit orders at round numbers. Instead of previous highs or lows, we draw horizontal areas of support and resistance at round numbers. Support and resistant levels are strengthened based on the number of times that a price trades at a particular level, how recently the area was tested, and the volume that was traded there.
A trend line is a line that connects significant highs or lows. They are graphical representations of projected support and resistance levels. They're commonly used to project the direction of the price and also potential consolidation and contraction levels. Analysts and traders must have at least 3 existing touches to confirm a trend line.
We can also use moving averages, Fibonacci retracement, and pivot points, which we'll cover in detail a bit later, to help us identify potential support and resistance areas. As technical analysts, we should study any popular tools or techniques that influence the trading decisions of enough market participants.
Great, well done. That wraps up support and resistance. This won't be the last time you hear me mention it. I'll be referring back to it as we go through the various indicators because the concept plays an important role in technical analysis.